Abigail, let's stick with those global markets. We're joined now by Daniel Lacalle, Tressa's chief economist. He is also the author of Escape from the Central Bank Trap. I don't think we've escaped from very much during the month of December, and certainly not central banks. The Fed certainly causing quite a lot of volatility this week. Certainly. John Williams trying to wind a little bit of that back over the last couple of hours. What have you made of the price action in December? What have you made of the gyrations that we've seen in these global markets?
I think that what we've gone is from a euphoria shock created by the expectations of synchronized growth, of improvement in emerging markets, rising oil prices, etc., to synchronized sell-off because of the fears of a radical slowdown, very quick deleveraging, and loss of liquidity. And so we've lost about 15 trillion, more or less, in the markets. In the global markets of market capitalization, which is about 1/5 of how much it went up in terms of market capitalization post-QE. So I think that we've lost a lot of the hype, a lot of the froth that was embedded in those expectations, and that what we're seeing right now is where you can start to look at opportunities, in my opinion, because while it is true that we're seeing a global slowdown, we're seeing downward revisions of growth, etc., we're not necessarily in an environment that we think is going to lead to a global recession or something really dramatic.
So things aren't maybe as bad as the markets appear to be portraying at the moment. A lot of investors that I'm talking to are saying, I'm going to wait until January before I put on big positions. I want to see what happens in the first few weeks, months of next year before I'm prepared to commit to some big conviction trades. What kind of signals are we going to be getting in January and February that are going to allow people to maybe take a more positive view of the world? You just said that things aren't that bad. So what are we going to get? What's going to tell me that actually the world isn't that bad in January and February?
I think that January and February we're likely to see consensus, for example, showing that growth estimates are not going to be revised down dramatically further. I think that also the fact that investors are getting used to what many actually believe was not going to happen is that central banks are actually raising rates and stopping QE, like in the case of Europe. And that is actually a positive, funnily enough, is that is markets getting out of the hype, getting out of the excess created by the central banks and looking back at fundamentals. I think that also the reality of not just macro growth, but also from the corporate perspective, is that earnings estimates are continue to be revised down, but not dramatically. That guidance is not that bad, and I think that we're seeing it as well today with some of the companies that are publishing results.
Nike,
yeah, absolutely.
What are your growth estimates for next year, Daniel?
Gold estimates. Well, I think that
growth estimates.
Growth estimates. Yeah, I think that. Sorry about that. Gold has been one of the topics that we've been discussing this morning. Yes, growth estimates for the next year. I think we're going to be moving around in a global growth around 3.13%. I think it's going to be revised probably down to the level of 3%, but still, you see, moderate but not dramatic levels of growth.
Well, as you mentioned it, let's get to gold then. We have seen a nice bounce. What are your estimates at Tracy for gold next year?
Well, one of the key factors that we're talking about and that I have been mentioning for a while is the risk of continuous disinflationary pressures. Technology, commodities falling, China slowdown, and currency depreciation from countries with very high US dollar denominated debt. Therefore, disinflationary pressures don't help gold in an environment in which growth is okay but not phenomenal. I think that gold can be an asset in order to preserve some, let's say, value, but not, I would consider, something that would rise dramatically in an environment of slowdown, but not dramatic recession.